Hey guys, hope you are having a great day so far. So what we have been talking and expecting has finally come into fruition. For months, when the markets began to bounce and pop, the corporate media quickly began singing praises about the success of the American economic strength. For weeks, we were exposed to the lies that the worst was behind us, that inflation was tamed and that it was only a matter of time before inflation was reduced down to the global standard of around 2%. Even on my own videos, which remained contrarian and bearish, some of my own loyal audience members began to tell me I was being too harsh, too stubborn to see the reality as it unfolded right before my eyes. However, as I explained in the dozen of videos I have released, the stocks were going up, and CPI data did cool, but everything else was getting worse. As I mentioned earlier in the year, corporate earnings were going to be monumental in two ways. Great earnings would be needed to launch stocks into new highs and bullish guidance would be required in order to quell fear. Well, earnings season came and outside of a handful of companies, the numbers were terrible. In fact, some of the companies that beat earnings, such as Nvidia, did not have anything to boast about. These companies revised their own earnings multiple times, driving down the number of what they expected these earnings to be. So after reducing the numbers and barely beating them, the market somehow decided to perceive this as a triumph, and it did so for a short couple of days, up until big investors realized that just because they beat earnings doesn't mean the companies are set for a bullish path in months ahead. Again, they beat expectations due to reducing what was expected of themselves multiple times, and their forward guidance was awful at best. Apple, Microsoft and many other tech giants missed. Meta, previously known as Facebook, during these past weeks, has pretty much canned their virtual reality team, meaning the project they invested tens of billions of dollars is now either set aside or will be disposed of. It's one of the main reasons they are one of the biggest tech companies firing the most amount of employees. So overall, earnings was a miss, so the next step was to observe CPI numbers and employment data closely. However, something funny began to happen. The Fed began to act incredibly sketchy. First, they announced that the manner by which they calculated the inflation numbers we saw would be changed. In the new way, inflation numbers come out much lower than in the previous manner which we were accustomed to, which lead me to think they are emphasizing a lot of time in figuring out a way to quell panic. The second thing was the inflation revisions, which turned the month of December from an improvement on inflation to a month where it grew. Then came January data, showing that inflation grew again, and now we are anticipating that the month of February has even higher inflation. Fellas, these are not little offsets in the data points, these numbers are indicators of a full-on reversal. The progress that we have witnessed for the last couple of months is slowly being eroded. What's even worse, which has been the subject of my attention in the last couple of videos, is the growing number of credit utilization among Americans while their savings are at a record low. This implies that American spending habits are no longer on par with the ability to afford the products or services they like. What's really dangerous is that Americans have begun to increasingly defaults on payments, both on credit cards and on mortgages. The rise on defaults poses a huge threat to the economy, and sets the country on a downward path that can only lead to huge and long-term disastrous economic implications. I watched Jerome Powell both on Tuesday and today on Wednesday, and though I do not proclaim myself to be a behavioral analyst, both the things that were said before Congress and more importantly, the demeanor by which they were said indicate to me that the Fed is both incapable and lacking in confidence at their own ability to reverse engineer the damage that they themselves started when they began printing endless money after 2020. We will go over some of the most important things said, but I like to summarize things beforehand, so let me put it to you straight and clear. The Fed believes inflation is likely to rise. Corporate America is now coming to an understanding that the current recession which we are in, which they so vehemently deny we are in yet, is here to stay and it's going to get much worse. The biggest data sets that have prevented Americans and institutions from going into panic mode is that job numbers have been fairly good. Unemployment has been down, and though that on itself has actually been driving inflation up, it has also given people false confidence. So long as Americans are getting paid, they can afford to buy things. That has been the mentality that market bulls have been laying on for a long time, but even that is yielding decreasing confidence. Any and almost every hope for a turnaround for the better this year was shut down unequivocally in these last 2 days. The things that Powell said brought everything to a grinding halt. It's no longer about how bad it can get, because he made it very clear that the worst outcome institutions expected is now the most favorable. Let's begin going over everything he said, but before we start, let me take a minute to cordially invite you over to my Discord. Guys, I know a lot of you are stressing over your trades, nothing is making sense and it's becoming increasingly difficult to read the market. I take great pride in the success we have had over the past week's trading. Members that followed our signals for entry and exits have yielded great profits, but more important, we have managed to acquire and maintain a high level of consistency. Join the Discord, it's open for anyone and everyone right now, by clicking the link below in the comments section and video description. There is something for everyone, whether you want to day trade or simply make one trade per week. We have a very active chatroom and tons of educational content, all available to you with the simple click. Alright, now that today's sponsor has been pumped, let's talk about Powell. Jerome the Joke Powell, the most controversial and important man in the entire world at the moment, gave testimony before lawmakers this week, both before the House Financial Services Committee and before the Senate Banking Committee. Powell explained that the economy has been much more resilient than anticipated, and then also said that inflation has shown more staying power than expected. To clear up the fog of these two statements, the reason he said the economy has been resilient is because Powell is forced to drive the narrative that things, as bad as they can be, are not at their worst. Even if tomorrow the S&P 500 were to tank 90%, Jerome Powell would still be forced to say the economy has been resilient. It's a way to sort of discredit the actual events as they have been developing in order to paint things favorably, so that investors and lawmakers aren't just given negative statements, which could heavily upset the markets. So in finer words, the statement that the economy has been resilient means absolutely zero right now. Ignore this ridiculous statement because the economy has been everything but resilient. In no way are Americans gaining purchasing power, becoming more stable financially speaking, or worries quelled. Things have gone from bad to worse, and there is nothing resilient about that. Back to his statements, Jerome Powell signaled that he and his colleagues were prepared to respond to new signs of growing inflation by raising rates, pretty much awakening the delusional market bulls who have been living in a pipe dream that somehow the Fed would pivot soon. Powell suggested that the Fed is ready to raise rates a lot more quickly if needed, though on Wednesday he did emphasize that no decision has been made ahead yet before the central bank's meeting on March 22. Jerome Powell made it very crystal clear that the big decision to hike rates will rest on the job market and inflation data points, which will both be released over the next week. What was very surprising to investors was that Powell suggested the pace of rate increases could pick back up. He said, and I quote, "If the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes. The thought is that the Fed could lift rates by a half point in March if data reports over the coming days remain hot, so everything will rest on the data coming out next week." For consideration, the Fed made 4 3/4-point rate moves last year. It then slowed down to a half point in December and to a more traditional quarter-point increase in February. With a bigger move potentially in the near future, investors and policy markets have become unsettled, upset and disgruntled. Again, everyone was dreaming about a pivot, but as I have been talking for months now, this market rally was just a retracement, not a reversal on the larger spectrum. We had 2 to 3 positive data points that improved while simultaneously watching the dozen other economic measurements decay nonstop. Once again, the focus will now be on the 2 major economic reports coming ahead of the Fed's meeting on March 22, the employment report on Friday and the fresh inflation figures on Tuesday. However, it is pretty much set in stone that rates will likely go higher. Powell said, and I quote, "The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. Continued resilience is a recipe for an aggressive Fed response because central bankers believe they need to slow the economy to wrestle down inflation. Investors increasingly expect rates to peak above 5.5% this year, and banks are now beginning to theorize they will actually go above 6.25 by the end of this year, which means that the outlook is that things will get worse, so expect a lower low on stocks if this becomes the case. SPY could actually fall below 300 at some point this year, which will make it hilarious to see how the current administration, the Fed and the corporate media cope through mental gymnastics to convince the world that we are still not in a recession. But believe it or not, none of what we have discussed so far is at the peak of important developments or catalysts. What we need to look at right now is at the labor market, because regardless of how high CPI comes, it is going to slow down. As I said earlier, market investors and institutions have long held to the premise that the low unemployment numbers are proof that the economy can withhold these difficult periods. Their bullish thesis relies solely on an economy that allows people to maintain their jobs and continue getting money, which circulates the economy overall. So what happens when the labor market begins to slow down? The answer to this is what will hold or break the markets. With this in mind, you might be wondering what Jerome Powell had to say when he was pressed by various lawmakers about what they foresee in the near future, and the answer to this was enough to send me and everyone with basic common sense into panic mode. After Jerome Powell was forced to say the quiet part out loud when it comes to the Fed's inflation-fighting policy, the way interest rates work is by slowing down the economy, which include the job market. This will slow down wage growth. In clearer words, the Fed is forecasting that the actions they will take will be directed at driving unemployment significantly up, because it's the only way to beat inflation as they see it fit. Powell was very uneasy, wrestling a way to say this without having everyone jump on him. In fact, based on the lack of proper answers, I am 100% sure the Fed does not have a plan or idea on how to engineer their way through this mess. Jerome was quite literally mumbling responses when asked how the Fed would attain this and what the effects of it will be. It is clear that the effects it will have will be considerably negative on the economy, and that the Fed will be forced to quite literally start destroying the only bastion of hope in order to fight inflation. Unfortunately, the risks to upsetting the economy don't stop here. Jerome Powell actually did a great job at stating that the debt limit is a huge risk. As I said in previous videos, which for some reason garnered me a lot of controversial responses, the debt limit is indeed a looming threat that will wipe the entire global economy off its feet. The federal government hit its technical debt limit on January 19 and has been employing accounting maneuvers to continue paying its bills. Unfortunately, the federal government is expected to exhaust these measures this summer. At that point, Congress will need to suspend or increase the debt limit to avoid a default. So far, politics rule Washington, and without getting too political, Republicans are unwilling to compromise so far. They insist they will not increase the debt limit unless President Biden makes deep spending cuts, which the president said he will not do. We can pretend to take comfort in that these two political sides will eventually find a resolution, but with deteriorating political fabrics between both Democrats and Republicans, the odds that this will happen only grow worse. That doesn't mean it will not happen, but there is enough evidence to suggest that the United States could indeed default on its debt, and we shouldn't just assume things will be solved and work out just because it happened in the past. It is a real threat that will 100% destabilize the economy and send us into a full-on depression like that which we saw in the 1930s, so don't deprive yourself from acknowledging this looming threat because it is here at our doorstep. I loved that Jerome was assertive in raising his concern over this, and I give him full commendations for that. Jerome Powell said inflation could be driven down if companies were to curb their own profits, which was kind of silly of him to say because no publicly traded company will curb their own profits for the betterment of the United States. In fact, if you have been a consistent viewer of my YouTube channel, you will remember about how we went over some of the facts that showed that companies are actually continually pumping up prices to fight off less customer traffic. Less people are going out to dine or drink, and restaurants, for example, have been forced to pump the prices for food to maintain their margins balanced. So what happens when even after pumping food prices up customers continue to fade over time? We know that gross profit margins have remained flat or have actually come down at manufacturers and sellers of household basics like toilet paper and cereal. Walmart and Procter & Gamble have both passed through once-in-a-generation levels of price hikes to try to keep these metrics of financial health steady as they themselves face sky-high costs. Powell took aim at corporate America, saying that these actions they have taken are only making things worse, which is 100% true, and I applaud him for that. But to assume these companies will all randomly begin to reduce prices collectively to appease the United States economy is a wild statement as it could come. The chances of Lisa Ann appearing naked in my bed tonight are billions of times much higher than corporate America taking one for the team. These corporations are like vampires, they are greedy and will not skip on the chance to make a penny to preserve anything that isn't their own pockets. In essence, there is no exit ramp for anyone here. The Fed will be forced to manufacture, a recession for the United States of America by driving unemployment up. That means less people working, which means less money will be spent, which means worse earnings for corporate America, which means higher crime rates will spike, which means less people will be able to afford loans and mortgages, which means defaults on payments for everything will rise, which will end with the devastation of millions of Americans, Generation Z coming into adulthood with odds that will make it significantly harder to attain financial success long-term, just like what happened to millennials after 2008. American corporations will do well to drive in divisive narratives that will make millions blame their neighbor for voting for the opposite candidate when in here the real crooks of all of this was Wall Street and the Fed. Right now, Everything rests on the reports coming out next week for inflation and employment. Based on that, expect a huge shift in the markets. They will either consolidate or drop ugly depending on the numbers that will come out. You can be certain to expect tons of statements by the administration and corporate media that will attempt to quell the situation by saying it's not that bad, just like Jerome attempted to quell worries from lawmakers by saying the economy has been persistently good, which after all we have discussed in this video sounds like an insult, which it is. I do not know when we began to allow important officials to lie to our faces so callously, but here we are in 2023, happening right before our very eyes. I expect the Fed to fully go through with raising rates above 6% at some point this year because based on the current economic data, there is just no scenario in which they win without doing it so. One thing that was not discussed is that the number of job openings in the United States began to fall off in January. Mix that with higher unemployment which is to come and you get a recipe for disaster. And lastly, I want to end this video on a very sour note, but with a clear heartfelt warning to every single one of you, but especially those that have remained optimistic about the market prospects. Stop ignoring the Fed. I know it sounds crazy. I am no fan of Jerome the Joke Powell myself, but you need to stop ignoring the Fed immediately. The magical moment you expect where the perfect scenario comes and everyone escapes fate is not going to arrive. The tight labor market is so tight that there are only 1.9 job openings for every unemployed individual. This is near the all-time peak recorded a year ago. Wage gains slowed slightly in recent months, but the Fed said it's above consistent with a 1% inflation. This alone will prevent any perfect salvation moment from happening. Stop buying into the conditions will be realized because the chances of that happening went from slim to atomic levels of small. Your eyes should be on the job report this Friday. The economy's likely to add far more jobs than the Fed expects, which means a much more difficult scenario for the Fed. With all of that said, I want to thank you for watching this video through its completion. It was a difficult video to make, and one that I personally hated making. I come from a very humble background. The events that took place in 2008 greatly shifted my personal life for the worse. It eroded my own possibilities and options back in the day. It brought my family into financial hardships to the point where we were not able to afford rent and payment on cars. I witnessed the strains this made in my family in more ways than one, and saw how it brought disaster to so many others. The chances for a huge market crash are high, so in these moments, please make sure to spend time with your loved ones. At the end of the day, it's all we have and all we fight for. Prepare as best you can and hope for the best. I will see you all on the next video, which will likely be next week when all the financial data we expect is out. Until then, join my Discord if you want a good chance at making money in the stock market during the turbulent times. It's open to everyone and you have absolutely nothing to lose and everything to gain by just clicking the link in the pinned comment below. Love you all, to the moon.